Not all debt is the same. Some builds wealth while you sleep. Some is a slow drain you barely notice. And some is a financial trap specifically engineered to be difficult to escape. This is every type of debt, ranked from the kind that can make you wealthy to the kind that is quietly destroying people right now. By the end of this video, you will know where every debt in your life sits on that spectrum and the one question to ask before you take any of it on. Mortgage debt. A mortgage is the only common debt where the asset you are buying has historically appreciated while you are paying to own it. The leverage amplifies the return. A $40,000 down payment on a $400,000 house means a 10% gain. In home value produces a $40,000 return on your $40,000 investment. 100% return on equity. No other debt structure available to ordinary people works like that. The hidden cost? Amortization. In the early years of a 30-year mortgage, roughly 80% of every payment goes to interest, not principal. You are building equity far more slowly than the payment feels like you should be. The house is real. The equity is real. The math just does not work the way the monthly statement implies. Good debt. Student loans. Sometimes. Student debt is the most contextual item on this list. A $40,000 loan for a nursing degree at a state school is fundamentally different from a $180,000 loan for a humanities degree from a private university with poor employment outcomes. The debt itself is neutral. The return on the investment determines whether it belongs near the top of this list or closer to the bottom. The rule that works: if your total student debt at graduation is less than your expected first-year salary, the debt is manageable. If it is more, the payments may constrain every financial decision you make for a decade. That constraint is the hidden cost nobody calculates when an 18-year-old is signing enrollment paperwork. Federal student loans carry income-based repayment options and forgiveness pathways that private loans do not. That structural difference matters enormously, and most borrowers do not understand it until they are already locked into one or the other. Neutral. Auto loans, depending on the rate. A car is a depreciating asset. The moment you drive it off the lot, it is worth less than you paid. Borrowing money to buy a depreciating asset is not wealth building, but it can be a rational exchange. If you need transportation to generate income, a car loan at a low rate to purchase reliable transport is a legitimate tool. The problem arrives when the loan becomes a mechanism for buying more car than the function requires. The hidden trap. Term length. The average car loan in America has stretched past 6 years. A 6-year loan on a vehicle that loses 40% of its value in 3 years means many buyers spend years owing more than the car is worth. If the car is totaled or you need to sell, the math becomes painful. Dealers profit from longer terms because they lower the monthly payment, which makes expensive vehicles feel affordable. The monthly payment is not the cost of the car. The total interest over the life of the loan is. Approaching danger. Personal loans. Personal loans are unsecured debt, meaning there is no asset backing them. A bank lending you money for a car can repossess the car if you stop paying. A bank lending you money for a vacation or a home repair or debt consolidation has no such backstop. Because the risk is higher, the interest rate is higher. Personal loans from reputable banks sit at roughly 10 to 20%. Expensive, but they have a fixed term and a fixed payment. The debt has a defined end date. You can see the finish line. That structure is meaningfully better than the alternative most people reach for: a credit card. Consolidating high-interest card debt into a personal loan at a lower fixed rate is a legitimate use. Using a personal loan to fund consumption you cannot afford is borrowing from your future self at a double-digit interest rate. Dangerous? Credit card debt. The average credit card interest rate in 2024 crossed 21%. That number deserves to sit alone for a moment. At that rate, a $5,000 balance paying only the minimum doubles in roughly 4 years without adding a single new purchase. The minimum payment is specifically designed to extend the life of the debt. Card issuers make more money the longer you carry a balance. The minimum payment is not a repayment plan. It is a revenue optimization tool for the lender. Here is the mechanism most people never see. Credit cards were designed as convenience products, not credit products. The original model was charge cards paid in full monthly. The revolving balance came later when issuers realized the carry was where the real money was. The rewards, the cash back, the miles. These are funded by interchange fees and by the interest paid by the half of cardholders who carry a balance. The person who pays in full is subsidized by the person who does not. The system is designed to blur that line. Very dangerous. Buy now, pay later. Buy now, pay later. Services are the newest entrant on this list, and they are moving fast. Klarna, Afterpay, Affirm. They offer zero-interest installment payments that feel like a smart workaround. Sometimes they are. A true zero-interest split payment on a purchase you are already going to make is a neutral tool. The danger is behavioral. These services are installed at checkout specifically to reduce purchase friction. The amount feels smaller. The decision feels lower stakes. Research consistently shows that buy now, pay later increases average order value. The product is not designed to help you budget. It is designed to help retailers convert more sales. The interest that appears when payments are missed is the profit center. Most users do not read the terms until something goes wrong. Extremely dangerous. Payday loans. A payday loan is a short-term loan, typically 2 weeks, designed to be repaid when your next paycheck arrives. The fees are expressed not as annual percentage rates, but as flat dollar amounts. $15 per 100 borrowed sounds reasonable. That is 390% APR. Most people do not do that conversion. They were not meant to. The structure of payday lending is built around renewal. Most borrowers cannot repay in 2 weeks, so they roll over the loan, paying another fee to extend it. The average payday borrower takes out 8 loans per year. The product is not designed for one-time emergencies. It is designed for repeat usage. The people who use payday loans are not irresponsible. They are people without savings, without credit access, without any of the better options higher on this list. The payday loan industry exists in the gap left by banks that will not serve low-balance customers. That gap is profitable. The worst, predatory installment loans and rent-to-own. At the bottom sit the products designed for people who have run out of other options. Rent-to-own furniture stores charging effective annual rates above 100%. Title loans where your car is collateral for a loan that costs more than the car is worth. These are legal products in most states. Most operate in gray zones where disclosure is minimal and the typical customer does not understand the true cost until the asset is gone or the debt has compounded beyond repayment. The question to ask about any debt. Here is the framework that unifies everything on this list. Before taking on any debt, ask one question. Is this debt financing something that will be worth more than the cost of the debt when it is done? A mortgage on an appreciating asset, potentially, yes. A student loan on a degree with strong employment outcomes, potentially, yes. A car loan on a vehicle you need to earn income, potentially, yes. A credit card balance carrying last year's vacation at 21%, no. A payday loan to cover a gap that will still exist next paycheck, no. Debt is not good or bad. Debt is a tool with a price. The price is interest. The question is always whether what you are buying with borrowed money is worth more than the interest you will pay to get it. Most of the time, for most consumer debt, the answer is no. But the monthly payment is designed to make that calculation feel unnecessary. That is the system most people never examine. And the people who understand it make different decisions than the people who do not. Subscribe if you want to keep seeing how financial products are actually designed versus how they are sold to you. And drop a comment. Which type of debt surprised you most on this list?